Ladies and gentlemen, good day and welcome to the Thomas Q2 FY2024 earnings conference call hosted by IIF Securities Limited. As a reminder, all participant lines will be in the listen-only mode, and there will be an opportunity for you to ask questions as the presentation concludes. Should you need assistance during the call, please signal an operator by pressing star, then 0 on your touchtone phone. Please note that this conference is being recorded. I now hand the conference over to Mr. Ranjit Cirumalla from IIF Securities. Thank you, and over to you, sir.
Thank you, Rayo. Good afternoon, all. On behalf of IIF Securities, welcome everyone to Thomas Cook India Limited Q2 FY2024 results earnings call. We have with us Mr. Madhavan Menon, Executive Chairman, and Senior Management Team. I now hand the call to Mr. Menon to begin the proceedings. Thank you, and over to you.
Thank you. Good afternoon, ladies and gentlemen. Welcome to the earnings call for the quarter ended September 2023. Let me kick off by saying that we registered a decent set of numbers in this quarter as well as for the half year. Over a period of the last 4 quarters, we have registered what we would call a recovery from where we started immediately after the pandemic, where, as you're aware, we lost most of our revenues. I think time has come now to say that the recovery from the pandemic in comparison to the pre-pandemic is almost done, if not already done. And going forward, we expect to register growth in our business under normal circumstances. Having said that, some of our businesses are still in recovery mode, but considering that the major part of the group has recovered, it's important to recognize this. A lot of this has been driven by a variety of factors. I think the primary factor is that there has been changes in the profile of the segments that travel with us. We are seeing a younger generation travel with us. We are seeing customization of holidays becoming a need of the hour. We are seeing people who are technology savvy. So we're seeing a fair degree of change in the profile of customers, and therefore, in anticipation of this, we had gone out and put technology into place, which would allow a customer to deal with us seamlessly from beginning to end if they did not wish to have a touch point. An important input into the profitability of the company has been the restructuring that we undertook alongside the technology upgrades that we undertook at the same time. So this has resulted in savings, and you will see both in the H1 as well as the quarter. If I look at Thomas Cook, I believe that our savings is approximately 32%, and that has dropped to the bottom line. So we are actually able to manage our costs and maintain the savings while growing the business. So I think we have, and if we look at the forward bookings again, there is a degree of optimism in terms of the growth of the business, and therefore we expect to continue. At this point, I'll hand it over to Mahesh Iyer to give you a detailed view of the numbers, and from there onwards.
Thank you, Madhavan, and good afternoon, everybody. Just to take off from where Madhavan left, I think it's been a decent quarter for us. And if you look at our income from operations, grown by about 50% for a comparable quarter last year, and that's about 1,235 crores has moved up to 1,871 crores, and consequently, our profit before tax has moved from 5 crores to 76 crores. Now, some of the key drivers behind this performance has been the financial services, travel services, leisure and hospitality resorts, and photo imaging. Now, what I mean to say here is that it's an all-round performance. All segments of our business have actually grown in high double digits, and that's a very good sense of how the business is panning out today and for the future. If I look at the profitability, that's EBIT across these segments, most of the segments have registered close to double digit, and when I say double digit again, close to the 40% growth in each of the profitability, with a clear exception in the case of travel businesses, which have actually grown manyfold. Some of the key drivers of each of the segments is what I'm going to cover in the next few minutes. And to begin with, about foreign exchange. If you look at the income from operations on foreign exchange, we moved from 63 crores to about 7 crores to a comparable quarter. Some of the key drivers for this from operations has been the growth on the retail business. Our retail portfolio grew by about 21%, and within that, which is on the holiday side of it, look at the education side of the segment, that grew by about 68%. Clearly, the retail holiday travelers as well as the education segment covered our revenues, and that flew into our EBIT. And if you look at our EBIT, that grew from about 20 crores to 29 crores. So clearly, a 21% growth in income and a 42% growth in EBIT. It's also important to highlight that business is now generating cash because there is a lot of float that is generated out of the credit card business, and that's now translating into I would say interest cost savings onto the business. So from an expenditure, it has actually started to become an income onto the business. Some of the other key highlights during the quarter have been our digital adoption. We've been talking about taking the foreign exchange business digital, which is what the customer has the choice of transacting with us either on our website or on our call center or a combination of both, other than the physical stores that we operate. Our digital adoption in the current quarter has moved up from 18.4% in September quarter of 2022 to about 23% in the quarter of 2023. So clearly, I think there is a 6% growth that we have seen, and that's largely driven by our investments and the ways that we are getting customers to transact with us. It's also important to highlight here that we launched our WhatsApp Forex. So unlike most companies which use WhatsApp as a service tool, we've actually expanded that as a sales tool also. So today the customer has an opportunity to transact with us on WhatsApp, do a KYC on WhatsApp, upload his documents, and the last mile fulfillment obviously will be done by our staff going and visiting the customer. So clearly we have opened one more channel for the customer to transact with us. If I look at the card issuance, card loads improved by 35% on a year-on-year basis, and if I look at in terms of number of retail cards sold, that's improved by about 21%. So overall, if I look at the portfolio, we had a steady growth in the current quarter. We've added some new corporate accounts to our portfolio, and I think for the coming quarters, we see this business continuing its run as we go on. Moving on to the travel and travel-related segments, if I look at the segmental revenue, it's grown by 9% from 899 crores to 1,432 crores. There are multiple segments within this, and I'll try and take you to the holiday, B2B and B2C, as well as the corporate travel segments, and then I'll get Devashish to talk to you all about the DMS segments that we have operated in. So clearly, a 59% growth in revenue has resulted in about 1,354% growth in profitability. That's moving from 3 crores to about 50 crores. Now, this growth in revenue has come from multiple channels. One, if you look at the B2C side of the business, I think while it was a shoulder quarter, as you would know, that April, June happens to be the peak travel quarter for us, and July, September is a bit of a shoulder months. But despite that, we've seen some fairly good run. Domestic demand was slightly subdued, as you would appreciate the fact that India was under monsoon, and our business does get impacted during that period. But our short haul and parts of long haul business continued. We had an extended long haul in that sense, went all the way till end of July and some parts of August. That kind of augured very well for the business. Apart from that, if you look at the B2B side of the holidays, we had some large movements across both brands, SOT and Thomas Cook, where we managed close to about 400 groups during this period. And this has kind of helped us to register a decent growth as far as the overall volume is concerned. If you look at the MICE business within Thomas Cook, we also manage the G20 events. As you'll appreciate that we mentioned that we are one of the 3 vendors servicing the common G20 portfolio, and that got concluded in September of 2023. We managed a total of 41 such events and generated a top line of close to 150 crores. Now, If I look at the domestic and the short-haul segment, we are seeing momentum in the coming quarters. You will appreciate that festivity has just about started. November, December is when there are a lot of holidays, Diwali and Christmas, and people will plan their holidays. So we are seeing momentum, as Madhavan alluded to it. Our forward books are currently tracking at about 32% ahead of what we had for the same period last year. Clearly, the momentum has built up, and we believe this will continue well into the next quarter. Talk about the corporate travel side of it. We had some major wins between SOTC and Thomas Cook. We added 8 new accounts to our portfolio. The total annualized billing of about 80 crores. Margins on this business continue to remain stable. Our mix in terms of business remains fairly stable, and we are focused on managing our capital costs as far as this business is concerned. Clearly, both from the foreign exchange and domestic travel business, I think we are doing fairly well, and we remain fairly confident of how the next few quarters will pan out for us. Vashish, can I ask you to take the DMS, please?
Thank you, Mahesh. The inbound and the DMS side, we registered a turnover of 662 crores, which is 4% up from what we did in the same quarter of last year. And it may be noted that it is 38% ahead of what we did in the pre-pandemic period. So the business is back in full swing. I must add one point that this is not the inbound season in many parts of the world, in India and Southeast Asia, where one major business lies. And so the forward bookings of those specific territories, we can say the business outlook is good. As far as the current quarter or the last quarter that's concerned, I think the units that did very well include East Africa. We have units in Kenya, which reported an increase in sales on volume generated from traditional markets, US, UK, and Germany. The Middle East witnessed high sales in spite of the fact that this was the summer season, and but again, it is higher than what it was last year. A strong growth coming from USA, LIT Pro, with a 26% increase in sales, largely driven by inbound passengers coming in from the European market. And Asian sales, coming to the Asian part of it, the Southeast Asia, Asian sales, which spreads across about 9 countries in Southeast Asia, started recovering its volumes, specifically in countries like Thailand, Indonesia, Malaysia, Singapore, and Vietnam. The next 6 months are critical for this business because that's where the maximum volume comes in, and we look forward to a similar trajectory of growth. That's on what I had to add on the destination management and inbound segment. And I would like to now hand over to Vikram so that he can talk a bit about the Sterling Resort, the leisure hospitality segment.
Thanks, Debashish. Good afternoon, ladies and gentlemen. My name is Vikram Lalwani, and I represent Sterling Hospitality Resorts as its Managing Director and Executive Officer. I'm also joined by my colleague, Mr. L. Krishna Kumar, who is the Chief Financial Officer at Sterling Holiday Resorts. It's a privilege to interact with all of you once again today. Traditionally, in the leisure business, the quarter that has gone by, that is July to September Q2, from a seasonality perspective, is actually one of the cleanest quarters of the year. During this quarter, we also witnessed climatic issues that disrupted business in some of the regions that we operate. The heavy downpours in Himachal, Uttarakhand, Delhi impacted at least 35% of the portfolio for nearly 8 out of the 12 weeks this quarter. Despite the seasonality and climatic disruptions, we are pleased to report that Sterling has still continued to remain profitable, and this is the 11th consecutive profitable quarter that we have actually presented to you. Our supply has grown by 8% on a year-on-year basis, given our thrust on asset-light expansions. This is on account of addition of 8 new resorts in the preceding 12 months cumulatively, and this has also enabled our Q2 supply growth as well. On a year-on-year basis, Sterling occupancy is still stable at 63%, and we have grown non-metro business ratio from 6% to 66%. This has enabled growth in room revenues by 11% Q2 and 18% YOY. We continue to realize average room rates upwards of 6,000 across all our resorts on a Y-on-Y basis at the end. Our overall growth in revenues has come in from increased food and beverage incomes, grown by 11% year-on-year and 8% QOQ. This continues to reaffirm our growth strategy towards being a dominant player in the hospitality sector. Distribution continues to grow with the help of our Sterling One platform that caters to travel agents, holiday partners, and corporates across the country. Our new non-member or FY product with a validity of 1 year was also launched this quarter for Sterling One. This product gives immense benefits to customers to holiday at any of our resorts with value adds on food and beverage and flexibility of multiple holidays across our portfolio through the year. With the launch of this new non-member FI products, we have also sunsetted the long duration membership products in Q2. So we will have no more acquisition of membership products, long-term membership products going forward as well. Business continues to generate margins of 30% and upwards based on seasonality, resulting in a healthy cash flow, free cash flow of 542 million versus 463 million on a YOY basis. The company is also cash surplus of 1,580 million and considerably has also lowered its debt less than 125 million. As part of a growth strategy on an asset-light mode, we've added 4 new resorts in H1 FY24, Shimla and Panchgani in Q1, and Y3 and Vadodara in Q2. The addition of Y3 strengthens the presence of Sterling in the Wayanad district in Kerala, with its second resort in the district, and now we have a total of 8 resorts in Kerala, and we will continue to grow that. Vadodara marks Sterling's foray in the resort management in the theme park segment. Sterling Atapi being the largest theme park in Gujarat, spread over 70 acres. Some of our resorts like Nainital underwent a development program in Q2 and has been subsequently relaunched in October of 3. Sterling also made its debut in Udaipur with new resorts in October 2023. Hence, as on date, Sterling has 45 resorts across 41 destinations in India and growing. Our pipeline is strong with the addition of at least another 6 or 8 more destinations in H2, both Q3 and Q4, taking our resort count to at least 50 to 52 by close of FY20 in at least 48 destinations in the country. And we will further drive the scale in FY25. This reaffirms the strategy to position Sterling as a formidable hospitality brand in the country. During the quarter, Sterling has also upgraded some of its product profiles in some of its resorts, rooms, restaurants, in some of the large format resorts like in Ooty, Kodaikanal, Yerkad, and Munnar to cater to the demand that have higher spend propensities into Q3 and Q4. The company has strengthened its IT systems by moving to a cloud-based product management solution system tailored for hospitality business in all our resorts during the current quarter. Cloud-based ERP solution, Oracle NetSuite, implemented within the previous quarter, further helped bringing uniformity processes across the resorts, including better cost management views. The company continues to invest in various digitization projects that will help bring in further efficiencies in the organization. All our resorts are now ranked 4+ on TripAdvisor, with 19 resorts being ranked in the top 3 in their respective destinations. 6 of our resorts are on 5. Sterling has also been awarded the best domestic leisure hotel chain by Today's Traveler. Continues to remain upbeat for the remaining of the year. With the upcoming festive holidays, 3. We also have all our destinations reopened post monsoons. There is a strong sentiment of domestic demand and that's continuing. And the Sterling strong pipeline growth in number of resorts in Q4 helps build this confidence that we will close FY24 with a strong performance and also getting into FY25 as well. Thank you.
Ram, can I request you to come in and talk about DI?
Yeah. Thank you, Devashish, and good afternoon, everyone. DI has had a fairly robust quarter on quarter 2 2024 as since 2023. As you see, our revenue has grown by over 30% from last quarter to last year's same quarter to this year's same quarter. Our EBIT has grown up by during the same term. There's been a very, very aggressive growth. This has been primarily due to a high revenue in markets like China, Hong Kong, and Macau that have come back to full operations. In China, we have blown the roof off with both of our parks, Disney and Universal, creating records of the highest revenue ever achieved by the park in the past 10 years of operations and photography. We had days when we had over $50,000 of sale in both these parks put together on a single day. It's been an outstanding comeback for China and Hong Kong and Macau, China particularly on that front. Our overheads have increased a bit during the same time, but they have all been leveled to a very good amount of consumption costs being reduced out. On a quarter-on-quarter, we're looking pretty good both from an operations, from the revenue and the EBITDA margins that we're getting. Over and above this, we've had key partnerships renewed all across the world, whether it's in Maldives or in Dubai or in the Far East. We had 5 new partnerships added on. A good number of them have opened up in Indonesia. The Taman Safari Group is the largest acquisition we've ever had. This is an account that we've been for the last 10 years. That's come over, and that kind of makes us probably the single largest imaging operator in Indonesia going forward. Our market share, both in Indonesia, Singapore, and Malaysia, in all the 3 places, are now crossing over 90%. And in Dubai, they are about 25% on the market share. So it's been an extremely great quarter, both from a business as usual performance plus new business coming in for the future. Something that's from the quarter that was going forward. Things look fairly even more interesting and aggressive. We have Saudi Arabia coming on board. We are launching our first 3 locations in Saudi Arabia in the coming week. In fact, one of it is already launched yesterday, and 2 more are launching in the next 2 days. Saudi itself is Saudi Arabia's business size is probably 2-fold of what UAE is in the next 3 years. And we are on the first call of all the Arabs out there. We've also been awarded one of the largest contracts up there in Saudi Arabia. The 6 tracks is coming up called as Qiddiya. So South Middle East region has a very strong upward forward-looking opportunity in the next 2 years. And all of this is thanks to Saudi for sure, which is one of the largest that's coming up. On the other side, in the Far East, our growth has been pretty strong. We also acquired and we've gone live with the only attraction that we don't operate in the whole of Singapore. So Singapore, we operate 95% was our market share. There's only one wheel or the wheel flyer that we didn't operate. And after 14 years of its operations, we have transferred that operations over to us for photography. So we become only souvenir imaging solution company for the whole of Singapore. So any attraction that is across Singapore is only covered by us. Singapore Flyer was the last one, and we just gone live yesterday as we speak. So it's been fairly good quarter. Mind you, the quarter 3 or quarter 2, as you guys call it, is probably is not the biggest quarter. The biggest quarter is the last quarter, which is coming up now, which is now December, and the team is all poised for traction on that. I think it will be one of our best quarters in the whole year. It has always been the highest quarter for the year. So we see 2023 closing up on a fairly robust note for us. Over and above all this, most excited the whole DI is waiting for is our new technology solution. That's going to be going live as we speak, starting from Maldives by this year and in the first quarter next year across the world. This new solution is something that we've been very, very optimistic and looking forward for, which probably will open opportunity that we've never been able to do on our current imaging platform for the last 15 years. On that note, thank you very much, and I hand over the mic back to Madhavan for him to talk on this.
Devashish, please.
So that's what we had from the management side, and I'll now hand it back to Ranjit, and then we may open up the floor for question and answers.
Sure. Thank you very much. We will now begin the question and answer session. Anyone who wishes to ask questions may press star and 1 on touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking questions. Ladies and gentlemen, we will wait for a moment while the question queue assembles. To ask a question, please press star and 1. Participants who wish to ask questions, please press star and 1 on a touchtone telephone. We have the first question from the line of Senthil Manikandan from iThought PMS. Please go ahead.
Hi, sir. Thanks for the opportunity. My first question is with respect to Sterling Holidays. So just on the room addition, so let's say over the next 3 to 5 years, what's the targeted room addition, and is it going to be 100% on the asset-light model? So that's my first question.
Okay, let's take Vikram here. See, what has happened is last year has been a year of transformation for us, and we've recovered exceedingly well over the COVID period, and it has been a year of acceleration. Now, apart from increasing the capacity utilization of our existing portfolio, we will continue to grow our portfolio. In fact, when we started off last year, we started off with about 30 to 33 resorts, and today we are 45 strong. We intend to be 52 by the end of the financial year. And we will continue to grow our footprint in India and also possibly in destinations where Indians travel to. So we are exploring those as well. They will primarily be on asset light. Now, if there is a specific number you want to attach to what I see 3 years from now, we are currently about 1,000 rooms with 45 resorts. With the current pace of scale, we will see our portfolio growing significantly and mainly on an asset-light model, which is right. So our expansion is far more balanced and strategic rather than actually just blindly adding rooms across destinations. Where we are able to network our existing destinations as well as ramp up business quickly in those markets, we will certainly be present in those markets. So that's the strategic focus going forward. Even to FY25, it goes with the 52 resorts this year. We are looking at even FY25 with the same of growth that we've done in FY4 and so on. So that will be the focus primarily in Sterling going forward.
Okay. Thanks, sir. Next is with respect to travel segment. So opening remarks, you mentioned that most of the recovery from pandemic has been done. So it's going to normal performance. So in terms of margins, this cost savings coming in. So what should be the margin run rate going forward?
I'll take that question on. So if you look at our current margins that we are making on the business, our gross margins or the realized margins on the product, we are about 15-16%. And we've kind of grown that by about 250 basis points from the pandemic level. Pre-pandemic, we were about 13.5%. So we are now at close to about 60%. Now this margin mix is, or rather it's an average margin because the long haul margins are different from short haul to the domestic. If you look at it, I think from a portfolio point of view, our margins are kind of come to a decent level. There could be another 50 to 100 basis points improvement that you can see from here on. What's more important to highlight here is that the cost transformation that we have brought about has reduced our cost base permanently. We are seeing a 30% reduction in our cost base, and we expect to hold on to that savings for a long period to come. The other important element to note here is that both brands, SOTC and Thomas Cook, are very integrated at the back end today, and the economies of buying and the scale at which we are buying are also adding to our, I would say, efficiency in terms of pricing and better utilization of the inventory that we have on hand. So actually reduces the losses that come on the inventory. It gives us economies of buying, and we get better terms from our vendors. Some part of it gets passed back to the market in terms of growing our market share, and some part we retain onto our bottom line. So clearly, if you ask me, we will retain our margin currently at the levels that we are, or slightly improve it, but the focus will be now to add more volume onto the top line. Also important to highlight, we talk about recovery. While we've seen some smart recovery happening on the domestic and the short haul side, long haul is far from recovery. We are about 58-60% in terms of recovery on the long haul. Long haul by definition is anything that is a travel beyond 5 hours of flight. Now on that segment, as you know, there have been challenges on visa, both in the European market and the US market. So that still needs to come back. A lot has been done. I think most embassies have woken up to this, and we expect a better summer. As you will realize, both brands, SOTC and Thomas Cook, have gone to the market and launched the European offering for the summer of 2024, and the initial reaction from the market has been very, very positive.
Okay, sir. Just a last question from my side. This is with respect to the debt carry on the books. So exclude customer advances. So what would be our net debt on the book?
Net debt actually is, we don't have, at a net debt level, we are, it's negative net debt actually, because we have cash surplus. Our overall debt position has gone down quarter on quarter. Right now, the overall debt at a consolidated level is 250 crores, down about 310 crores. Overall cash and cash equivalent is about 1233 crores. So the net is about net positive is about 950.
So this cash balance of around 1,200 crores will include the customer advances and the float?
So if you include customer advances, you also need to take out the vendor advances. So I would not like, customer advances will have to be netted against the advances. So they're both asset and liability items.
Okay, sir. Yeah. Thanks. That's it from my side. Yeah.
Thank you. Before we take the question, a reminder to participants that you may press star and 1 to join the question queue. The next question is from the line of Anushka Chitnish from Arihant Capital Markets. Please go ahead.
Thank you for taking my question, and congratulations on a great set of numbers, sir. I just have one question in that now that FY2024 is a year of recovery for the travel segment in general, how do you see competitive intensity shaping up for Thomas Cook?
Okay. So look, I think the market has changed definitely post-pandemic. I think we've been seeing this for some time now. Customer preferences have changed, habits have changed. The profile of the customer has actually changed. They are younger, and we are now attracting younger travelers to our brand, both SOTC and Thomas Cook. And from a preference point of view, customers are now preferring to take more shorter breaks and frequent breaks as compared to one long break and maybe one shorter break that used to be pre-pandemic. So what we're seeing now today that there is a lot more demand. There are new entrants into the travel market. The ability to spend, the buying power is much higher. So you're actually going to see a market expansion. So to that extent, we believe that there is enough and more room for everyone to coexist without having to need each other's share. From an intensity point of view, as we have said before, we don't compete with OTAs because we are not component sellers. We are focused on package offering, and that's our core competency, and we'll continue to focus on our core. We are also very clear in terms of what we can offer to the market because India, if you take as an example, so far Can I be relevant in each of the states that offers an offering? Maybe not. So we've chosen some markets, some destinations where we want to actually be material and we want to be actually making a mark there. So we will be focusing on that, and we have already identified those markets for ourselves. Similarly, both the brands SOTC and Thomas Cook are very strong on the Europe and the US side. Can we build some muscle on some short haul? I think we have identified that and we're working towards it. So honestly, intensity of competition does not worry us at all, because I think we have enough and more leg room, and the tailwinds for this business seems very strong.
All from my side.
Thank you.
Thank you. Participants who wish to ask questions, press star and 1 on your touchtone telephone. The next question is from the line of Ankush Mahajan from Axis Securities. Please go ahead.
Sir, thanks for the opportunity. Question. Sir, earlier there was a news that we have this brand, Thomas Cook brand, could be expired on 2025. So could you throw some more light on it? So my next question is that if you talk about the DMS International inbound, where 100 nationalities, they are entering into India, Sri Lanka, as well as Bhutan. So these people coming from the US, Europe, already there is a session is going on. So would you throw more light on it?
Devashish here. To answer your first question, we had bought out the Thomas Cook brand for use in specific markets of India, Mauritius, and Sri Lanka back in October of 2019, and so we now own the brand in perpetuity. So there is no threat of the brand going away from us at any point of time. As far as the second question is concerned, so I think the inbound and DMS business has a very large set of clients and a very wide range of clients coming in from US, Western Europe, parts of Asia, etc. We have, in fact, interesting part of that, we have seen the DMS business actually recover faster post-COVID than any other part of the travel business. So to give you examples, the markets in US, markets in Middle East and in Africa were among the first to recover, even before the Indian market started recovering or the Southeast Asian market started recovering. So I think we'll need to consider the fact that while, yes, there is a recession in the economy, but the recession doesn't affect everyone in the economy in the same way, right? So the set of clientele that we are catering to may be less affected by the recessions in those particular economies than others are. And it may not be right to generalize that it has a recession and therefore there is the need for travel will be less. It is really on the category of travelers. Maybe if you are looking at backpackers, yes, there could be impact on that. But of course, we do not really cater to that extent.
So momentum is there in DMS International.
I'm sorry, I didn't get that. Anything else that you asked?
Momentum is there in international DMS.
Absolutely, the momentum is there. The momentum is there. Is much more than what it was in 2019. As a point of reference, before COVID actually hit us, we are well ahead of that and will continue to be ahead.
So my last one is that in Q2, even in the MICE portion in the revenue is quite big this time due to G20. So how would be the portion in the upcoming quarters? Because the gross margins are quite high in the MICE now.
No, let me try and take that question. This is Mahesh. If you look at the MICE business, the MICE representation here is two brands, SOTC and Thomas Cook both. It's on the Thomas Cook side of the business where we manage the government portfolios, more specifically the G20. Obviously, next year we're not going to see a G20, but the part is that we've now heard the government segment. We started working with multiple ministries as a part of this entire engagement with G20, and we believe as the government now uses this opportunity to showcase India in a much better way. There is also a rub-off effect on the domestic tourism as a result of this, because it has showcased so many states, its culture, its tradition, and everything else. So I think from a moment point of view and an outlook for the next, 5 years, I think India has set the stage to welcome foreign visitors to come to India. This actually helps our inbound business. It will help our ancillary businesses. It will help our domestic business and also help build momentum through a new line of business, which is the government business. Apart from that, if you look at our international business, they continue to do well. We've been actually growing at about 15-20%, and even in the current quarter, the growth compared to the previous comparable quarter is about 25%. So that volume continues to come in. The spending, which is more the R&R programs that corporate runs, they have actually been coming back and investing in the distribution channel, just as any other company will do to increase their skills. I think most companies are now focused their personal spending. So we don't see any slowdown that will come. Maybe some part of the portfolio will get replaced, but clearly the momentum is there.
Thank you, sir. Thank you very much.
Thank you. The next question is from the line of Ashish Chauhan from RV Investments. Please go ahead.
Good afternoon, sir. This is Ashish here. My first question was regarding cash that we have on a that is close to around 1,200-1,300 crores. So are we looking at some payment to the investors in the form of dividend of that, or is this for a merger and acquisition that might take place for our inorganic growth?
Okay. Is that the only question, or you have more?
I have a few more questions.
Okay. You want us to answer this one before?
Yeah. So one by one, I'll be more.
Okay, fine. Great. No, great. That suits us also. To answer your question, yes, we have cash on our books. Obviously, part of the cash is also the float that we have on the card, on the foreign exchange cards. As of now, we do not have a plan to use this cash for either a buyback or for other acquisitions, etc. Our strategy on this is, I think, fairly clear. We want to use our cash to pay off our debts over the next couple of years. Thomas, as a standalone unit, does not have any short-term debts as of date. It has some long-term debts which we are trying to repay. Likewise, in some of the other subsidiaries, there are debts which we are gradually coming down. As I mentioned, overall our debt is around 200 crores, which we are trying to pay off in various ways. The first priority is to become debt-free, which will obviously increase the overall and of course the PAT.
So I would like to give a follow-up question on this. That cash is somewhere close to 300 crores and the debt is close to 200 crores.
Yeah.
So the debt can be easily paid off, right?
Debt, as I said, we do not really have short-term debt, which I mean overdrafts, which can be payable easily. The long-term debt usually has some covenants on payment, when I can pay, etc. And we can only pay on debt. What we're trying right now is to pay off some of the longer-term debt ahead of schedule. And obviously, that's not an easy task because the banks do not want to be paid early because this results in loss of earnings.
Okay. Something my question was corporate travel is just part of our revenue. So are we looking to get that side as well?
I think that's not the way to look at it. It's not 2% of the revenue. It's only that is the way it has to be recognized from an accounting point of view. We only recognize the revenue that we take on the business and not the top line sale. So the payment mix that you see there, while all other businesses within travel group are in form of top line sales, this is only the realized revenue on the business, and that's why it looks at 2%.
Okay. So sir, can you give me a light on over there? What is the actual thing there, except for the area?
So if I look at a pure throughput, I won't like to call it turnover, but purely as a throughput, corporate travel accounts for close to about 29% of the overall sales number, overall throughput number.
Okay.
The other advantage of having corporate travel is that we manage to cultivate corporate relationships which are very useful, which may be very useful for getting MICE contracts or getting forex out of the business. Some of these corporate relations can also lead to employees buying all the B2C leisure travel packages.
Okay. And so the last thing, since there was the World Cup over here, so this might have been a bit positive for us, just 20. Was there anything that affects our adds to our revenue?
I can't necessarily put a number to saying that whether the World Cup had a fillip. Yes, we got some inquiries, but obviously, we are not selling World Cup tickets, and people who come would want to buy a package which is inclusive of a World Cup ticket, and we didn't have too many. There were a lot of inquiries for the coveted match in Ahmedabad. We managed to sell some, but I wouldn't say that as a large part of our business. That's a small portion. So not necessarily, but yes, I think the attention to India was very large. So just after a G20 World Cup happening in India, I think the world was looking at India. And I think the stadiums that we put up, Lucknow Stadium, the Ahmedabad Stadium, I think we kind of made a mark in the global space. And that's what we will look at. These are not short-term benefits. We have to start looking at from a long-term space.
Right. Sir, the last thing I just wanted is, can you give me the payment completely?
Sorry, schedule for?
Debt repayment? Like by when can we expect us to be free?
The next 2 to 3 years.
Next 2 to 3 years. Okay. Yeah. Thank you so much, sir.
Thank you. The next question is from the line of Dhaval Shah from Girik Capital. Please go ahead.
Yeah. Hi, sir. Thank you. Sir, is it possible to give breakup of different businesses under travel and related, like outbound DMS, DMS international, domestic travel? What is the revenue for the quarter?
So in terms of the revenue mix, I can give you in percent and terms, and I can just easy to decipher that. So MICE was about 31% for the quarter, corporate travel 10%, because we, like Mahesh mentioned, we account for only the money that we make there.
Yes.
DMS was about 46%, long haul holidays 9%, short haul 6%. And obviously, all this will add up to a little more than 100 because there are some inter-segment eliminations, because we use the DMS businesses also to service some of our outbound business, and so we have to take a 5% cut on the inter-segment elimination.
Okay. So like last year we did around 1,000 crore in MICE, and this year also we would be growing on that. How do you see this business over the next 3-year period? And where would you compare it to, like, your experiences, how the MICE business has behaved in various developed geographies or other comparable economies of the world? What is the opportunity size in this?
Look, I think it's from the previous question that was there, I kind of alluded to that. I think if you look at the MICE, the definition is MICE meetings, conferences and exhibitions, each of which presents an opportunity within itself. There are multiple segments within that. Example of weddings. That's a great opportunity for us. But we don't play that space. There are parts of it that we do for some of our corporate customers, but that's not a large space. So that's an opportunity if you want to say so. If you look at sports, that's become a huge opportunity as well as the MICE is concerned. So as we speak, we are managing the national games in Goa. So that's an opportunity that has ever existed in the past. We spoke about G20, which we managed, so clearly that's a new opportunity. If you look at the international destinations, most of our corporates have now come back and now looking beyond virtual events and domestic events to international events. The popular markets remain, and we are trying to create new itineraries, new destinations for them, because a lot of these people who operate in this space, the paint industry, the insurance industry, I think all of them have been to that place multiple times over, because most dealers work with more than one company, so they have been to one destination or other. So I think the important thing is to create new experiences for them, new destinations for them, and how you bring that element of that wow feeling that you need to create. So I think it requires a specialized set of skill, and I think we believe we have that skill between both the brands, and we continue to invest in looking at the new opportunity that comes about. If you look at the size of the MICE business, there is an estimation which is that this is likely to grow 7x over the next 10 years. So clearly, I think we have enough and more room to grow.
Interesting. And sir, just one repeat question on the cash. I'm a little bit, I want to understand more clearly that 1,300 crore which we have on the book now, adjusted for the float and the vendor advances what we give ahead. What will be like cash which is free and like which you can invest in under like cash. So what is the absolute amount which you can actually use down the debt or you dividend?
About a couple of 100 crores.
Okay. And on the float, how much do we earn? And what would be the float number out of the 300 crore?
Okay, the float number. Okay, how much we earn is an interesting question because there is. I'll go a little bit into what is done on the float. Some of the money is fixed deposit where we earn some amount of interest. It really depends on the currency in which the float is kept. Some currencies earn more interest than others. Some amount of money we have to keep in our Nostro account because it also have to manage the encashment that happen on the card on a daily basis. And the balance money we also use to manage our working capital. And let me just take a little more time on this one. So what we typically do is to swap this money on a daily basis and convert that to INR only for the case to take care of the requirement. The advantage of doing that is that it's arbitrage on the short-term borrowings. So instead of borrowing money at 8.5 or 9%, I can do a swap at say about 3.5% or something like that, and therefore save close to 5.5%. So that is what I'm doing.
Okay, and you do this on a day, it's like on a daily basis, like
it's a daily basis, yeah. And since it's a swap, there is no forex risk associated with this.
Okay. So, in last month, how much would you have swapped?
Every day we swap, no. So, I mean, how do I put a number to it? Depend on the daily requirement of cash that I have. Our business is the foreign exchange business is a money business, right? So some days we have a requirement for if the market there is a great demand for encashing foreign exchange. So there will be a big amount of demand for rupee, which is what I need to service that demand. I will do more swaps. On days when the demand is less, I will do less swaps. So it will really depend on the demand for the. There is no fixed number.
Understood.
And very tightly. All I can assure you is that we have our own billing room. We have a set of people who assign this task on a daily basis, and they do that very diligently. It's a very, very tightly controlled process. We need to remember that we are a authorized dealer, and therefore under the continuous scrutiny of RBI. And therefore, we are as careful as the banks are, or at times even more, to make sure that we do not, we set the boundaries.
And sir, even banks are offering currency cards. So do we have any? We would be having some tie-up where, say, ICICI Bank is offering a card, so where we would be the backend partner or something like that. So one is a customer goes directly to Thomas Cook office, and then you buy the card when you want to travel. But banks are also doing the same thing. So how do we manage that issue?
So Dhaval, let's take that question, Mahesh, again. First and foremost, I am not a redistributor of a card. I issue my own prepaid cards. I have arrangements with all the three network partners, which is Visa, MasterCard, and RuPay. The RuPay is limited because they currently only offer in the Dubai region. It's not expanded to other geographies. We offer all the three, and they are compliant with the regulation requirement in terms of giving the customer the choice of the network partner that he chooses. We also have variants on the card, which is multi-currency and one currency, which means if the customer is traveling to a single point, he can choose the currency that he wants. Or if he's traveling to multiple geographies, he can pick up a multi-currency card. Each of them comes with its own benefits of safety, security, convenience, reloadability, and is accepted worldwide. From a USP or a competitive landscape point of view, it's important to highlight that Thomas Cook for the past 2 quarters has been the number one issuer in terms of volume of prepaid cards in this space. And we compete here with banks and other money changers who operate in this space. We distribute this card to our corporate customers, our retail customers, and also through third-party agents, which are by nature. So we have a fairly good portfolio, and product has its own USP in terms of how commercials are treated. And I think we've been growing it. I have been mentioning this before. We've been growing at 35%, and we expect that growth to continue.
And just to re-understand, so all our cards are your Thomas Cook card. So there's nothing like co-branded, like Axis Thomas Cook card.
So what I would say is that everything is Thomas Cook card. If a Thomas Cook signed up with a partner and I need to do a co-branding arrangement with him, it will be Thomas Cook plus him, but it will not be a brand plus Thomas Cook ever.
Okay, and the last question, this was the annual report. So we have certain related transactions with other FSO companies. Now, number. So would all that be related to corporate travel service or would it be something else?
Depend on what is the requirement. It could be corporate ticketing, it can be hotels, it can be packages like, for example, MICE, etc. But let me assure you one thing, that all the related party transactions are audited. Specifically, there is no requirement for a third-party certification, but we do insist, our board insists on getting that done. Every quarter, we have an audit of all the related party transactions, just to make sure that they are done properly, meet the transfer pricing requirement, the benchmarking requirements, so on and so forth.
Got it. Wonderful. Thank you very much. Good luck.
Thank you. The next question is from the line of Mithun Aswath from Kiva Advisors. Please go ahead.
Yeah, sir, I wanted to understand your travel-related business. Any outlook for Q3, as well as have you reached the run rate of pre now, or there's still some time to go?
Mr. Again, hi, Mahesh here. I think you missed our initial commentary. As we said, most part of our business have reached close to pre-pandemic. It's the intra-businesses, it's the long-haul part of our holiday business, which is currently trending at anywhere between 58 to 62% of the pre-pandemic numbers. Short-haul and domestic have already crossed that benchmark. If you look at DMS business, and which is what Devashish covered, some parts of our DMS business have already got closer to the pandemic. Some other markets are still trailing. They are about 65 to 80%, and we expect that run rate to catch up very soon. It's a mixed bag, but within the India business that we operate, corporate travel and B2B holidays have already surpassed the pandemic level, and they continue to perform well.
Right. And thanks for that. Just want to understand any outlook for Q3 and Q4 that you're seeing, because your Q2 is actually non-seasonal, done well, and Q3 you will have the festive season and the holidays in October. How is the outlook so far? Or do you expect margins to rise in the travel-related business going forward?
Midun, actually you answered the question. The festivities and the tailwinds that we associated with it are very buoyant to our forward bookings, and I think we put that in our press release also. Our current forward bookings comparable to a year ago are at about 32% higher, and we see the tailwinds in us. The activity and some part of excitement around all the holidays will take this further. As far as Q4 of FY24 is concerned, it's a little early to comment on, but it's important to note here that two brands, OTC and Thomas Cook, have gone to the market with their alleged offerings on the European side. So we are heating up for the summer, and I think we are expecting from initial response, it's just about 2 days that we do it. Initial response tells us that the market is well geared to bounce back.
Yeah, just a couple of 2 questions. The margin side, the travel-related business, is there scope for further improvement?
Well, if you ask me, as I said, from a gross margin point of view, we've expanded our margins from pre-pandemic by about 200 to 250 basis points. Can we go further? Maybe there is some room, and there are reasons why I say what, because the input costs are higher and we pass some of this back to the customer. There is consolidation of buying that's happening. We are reducing our inventory losses, so all of this keeps adding back to the margins that we do. So there could be some expansion. I think most of it has been done. Beyond that, we don't want to get a threshold where we start getting expensive to the market. So I think we've got to a decent 16.5%, and the 50 to 100 basis points. That's where we'll pick up.
Just to add to what Mahesh here, Nitin, while the gross margins are, as you heard what Mahesh said, but there is scope for expansion at the EBIT margin level, because as the volumes pick up, the volumes keep on growing, fixed cost will not grow at the same rate, obviously. So there will be a gap that will be there. So if you see our current margins for the quarter is about 3.5% at the overall level. We expect that to move up because of growth coming back. We'll probably see expansion of about 150 basis points to that over. I'm not saying next quarter, but over the next 12 months, over 3 to 4 quarters, let's talk about. So we should see an expansion of 150 to 200 basis points there.
Excellent. One last quick question on cash, 40 crores, debt 79. What's your free cash? Let's float. And what would it be?
You probably missed the answer to one of our earlier questions. So somebody else has the same question, and we said that ballpark is about a couple of 100 crores. That's what we have right now. But we expect this to grow. Our our cash flows, the free cash flows are coming back, and we expect that to we used to earn in the range of about 150 to 200 crores of free cash. We will move to that level and expect that in the coming years. So you'll see this free cash growing.
Great. Thank you and all the best.
Thank you.
Thank you. The next question is from the line of Shubham Zope from Sycamore Advisors. Please go ahead.
Hello, am I audible?
Yes,
Hello.
Shubham. Please go ahead.
Yeah. Thank you for the opportunity. I have a question on the margin front. First is on the Forex side, Forex services. So what was the primary reason behind EBIT margin contraction in financial services? And what is your long-term guidance for the segment margin, for the margin front, EBIT margin I'm talking about? And second, you mentioned in last question about EBIT margin for travel segment. In last on call, you gave the guidance of EBIT margin of from 6 to 7%. So is our guidance same at 6 to 7%? And if same, then when we expect it to achieve? These are my two questions. Thank you.
Okay, let me take both the questions, beginning with foreign exchange. I think, as I mentioned, you'll appreciate the fact that July-September quarter is not a travel quarter. It's not a peak quarter. The mix of business that we operate here is different from the previous quarter. So it's not necessarily comparable. I think the comparison is comparable quarter last year. And if you see our EBIT margin on the financial services has moved from 30% to 37%. So that's a 500 basis points improvement. Just to make a point in terms of the margin, the EBIT margin for the the sequential quarter, it's important to note that in that quarter we also had a large movement for one of the premier banks in the country. So we were managing a large traffic for the Hajj, and we had delivered some large portfolio there. So some revenues that came in, which was a high margin business. So that's not available in the current quarter. But steady state, as you see, on a comparable quarter basis, we have expanded our margins from 32% to 37%.
Okay. Thank you.
The question on travel, I think you've seen the expansion in margin, and I think what Debashish and I have been saying is businesses are on different paths of recovery, and they are still not fully there. As the revenue starts adding up, our fixed costs are not going to go up, and a lot of that is going to flow back into our profitability, which will improve our EBIT margin. I think that's the way to look at this.
Okay. Thank you.
Thank you. The next question is from the line of Hatim Uchwala from JM Mutual Fund. Please go ahead.
Yeah, hello sir. Thank you for the opportunity. Sir, my first question is if you can talk about the visa issue in some of the outbound long haul travel, whether there is some resolution in the visa availability.
Sure. So again, Mahesh, yes, there has been improvement. If you ask me, within the Schengen country where we had close to 16-18% rejections, we've seen that percentage is going down. Visas have become slightly more easier as far as Switzerland and French visas are concerned. Also, as we heard, most of the embassies have beefed up their strength. We are seeing more number of people, more hands there to process. And one welcome change that has come in is that travelers to Schengen countries now can apply for a visa 6 months before travel, which was not the case before. So I think from a forward-looking perspective, some of these pains of going last minute and trying to look at rejections will get eased off. The proof of the pudding is when the summer season gets operated. But I think directionally we see the right steps taken. If you look at the US side of it, which is another long-haul destination, I think there's a report that's come out today. I think the number of wait days as far as Delhi is concerned has come down substantially. And I think Mumbai has also, from about 1.5 years, has come down to less than 1 year. And I think as the more come up and the allocation for number of visas goes up, you will see that coming down. So I think it steps in the right direction. We expect the situation to be much better than what we were while we were dealing with the summer of 2023.
Just one question is that H2 on travel and forex business should be much better than H1, right? Is that a correct assumption?
Look, it may not be absolutely correct because of our travel business happens in the April-June quarter. So if I plot a financial year, April-June will be the largest quarter that we have, followed by July-September in some form, and then October-December again slightly coming up, and then Jan-March will be again an investment quarter. That's when we start investing for our summers ahead. So that's typically seasonality, a high coming down slightly, going up slightly, and then down again. That's the kind of shape you will see. It's more like a wavy curve, and from a percentage point of view, I can broadly say about 40 to 45% or maybe close to 50% will happen in the April-June quarter, and the rest will be spread in the next 3 quarters.
Yeah, and inbound is slightly different because the inbound portion or the inbound and DMS basically can bulk up more in the second half of the year, which is because the winter season in Asia, and we have 2 key businesses there, in Southeast Asia and in India. So that tends to bulk up and make up for some of the shortfall, if I may say so, on the outbound and miles part. So, but still, at the overall level, I would say ballpark about 60% will happen in the first half, 40% in the second half, something like that, in that range.
This is for the travel and forex business, right?
This for I'm talking about the travel business specifically.
Okay. Last question is resort business. What are the ARR and occupancy?
Vikram, would you like to comment on this one?
Yeah, sure. What's the ARR and occupancy? All right. So the occupancy is about 63%, and the ARR is about 6,000 for H1, and H2 will also follow where Q3, which is October, November, December, shall kind of be in sync with what Q1 has been, and Q4 shall be in sync with what Q2 has been.
Okay. Thank you, and wish you all the best.
Thank you.
Thank you.
Thank you. The next question is from Ashish Chauhan from RV Investments. Please go ahead.
Thank you for giving me the opportunity again. So this question was regarding the India-UK FTA. So with that FTA happening, there will be a lot more students traveling and travel taking place. So will that be a benefit to us?
It should, because as I mentioned in my commentary for the forex segment, education forex is a large segment for us. We've been growing steadfast in the current year with some issues around Canada. I think UK has become a very prominent market, so we'll see the demand going to UK. And with this new FTA arrangement, we'll expect a lot more students to travel. Something important to note here that we also launched a prepaid product, getting the student, which is not anybody. Yeah? And clearly, we believe that there is more room for us to grow in the overall segment.
Sir, and one more question was regarding Sterling Resorts. There was in the last phone call we had spoken that there might be an increment to 6 more resorts to this Sterling. So has that taken place already?
Sorry. Come again with the question.
Yeah, it's a question.
If you could just repeat the question again. I
made that in the last phone call. We had mentioned that Sterling Resorts will be adding 6 new resorts in the H1 FY2023. So has that been taken place?
Yeah, in fact, we have added 4 in 2 in quarter 1, 2 in quarter 2, and we've already opened 3 in October. So we are pretty much, we have another 5 to 6 in the pipeline more till March.
Then our occupancy rate is close to 63%. So when do we look like reaching close to around 70%?
So let me clarify this. One is there has actually been a growth in supply of almost 8%. And despite that, the occupancy is actually at 63. So that means actually the number of room nights have gone up, number 1. Number 2, we are also in a seasonality business. What happens is in peak times, you can even hit 90-95%. In lean times, you are actually hitting 50-55%. So actually, that's how the weighted average actually goes between 60-70%. Traditionally, leisure business, for example, weekends you're actually running with high capacity utilizations. And on weekdays like Tuesdays and Wednesdays, you're trying to build volumes. So I'll be very frank, the 70-80 looks for a leisure business it looks slightly impractical here. Therefore, we are looking at about 60%, 270 days in a year are regular periods, 60 days in a year are super peak periods. So in that ratio, you're running actually between 60 to 70 in an increased supply mode. So that's where we are actually today.
Thank you for the opportunity, sir, and all the best for the next few.
Thank you.
Thank you. We have one last question. We take the last question from the Manish Parekh, individual investor. Please go ahead.
Hi, sir. Sir, just one question. Anything on revenue guidance for next few years? How you are looking in terms of just traction in all the businesses are there. So, as an investor, can we get a ballpark number in terms of revenue guidance?
Manish, we do not really give out revenue. We do not have a practice of giving out a revenue guidance. But if you have heard all of us over the last 1 hour or so, you will get a fairly good idea of what the trajectory of growth is likely to be across all the segments. And what we would request you to be patient and see the growth being delivered quarter on quarter. We do not really want to make a specific comment on how the growth will be in percentage terms or absolute terms over the next couple of years. But it will be we have recovered from recovered back to the pre-COVID levels, turnover level, and at a profitability we are far ahead of it. And the best of our days is yet to come.
Thank you, sir. Thanks a lot. Thanks for your thank you. Yeah.
Thank you very much. That was the last question. I would now like to hand the conference back to the management team for closing comments.
Thank you very much, ladies and gentlemen. Appreciate all the questions that you've asked. If you do have any follow-ups that you want more clarity on, please feel free to reach out to Debashish Nandi, who's Group CFO, and Urvashi, who handles our investor relations, Urvashi Bhutani. I'm sure you have access to both these names and their contact points. Thank you very much again, and have a great weekend.
Thank you very much. On behalf of IIFL Securities Limited, that concludes this conference. Thank you for joining us, ladies and gentlemen. You now disconnect the lines.